A lot of lenders that advertise assumable loans, it's a bait and switch deal. It's a marketing piece that they put together, and they want to be able to pull the consumer into their office and ask about this assumable loan. And when they actually crunch the numbers, it doesn't work out. And then they go into, well, since you're already here, we got other products. We got FHA, conventional, VA. What do you want to use to buy a home? You're already qualified. So that's kind of like bait and switch. When you hear it, especially right now in the seller's market in Sacramento. So today, that's going to be the first thing we're going to talk about is assumable loans, because we're still getting a ton of you guys asking us about assumable loans. And we kind of want to talk about it because we did have a client that were pretty close to going through with it, right, Lisa? And when we found out the details about it, it wasn't too sexy anymore.
Technically, assumable loan is just that. You're assuming somebody else's loan. So say, for instance, if somebody bought their home for $300,000 5 years ago, they're a veteran or they had a VA FHA loan, you can absolutely ask the seller if their current lender is willing to allow that loan to be assumed by you. You still have to go through the qualification process. It's not all of a sudden you come in, you got whatever funds that you want to, and you assume it. No, you still have to qualify for that program and all of that, like normal guidelines, okay? So here's the thing. How does it benefit the seller? You have to think of it that way. So now with that home, the house is now worth $500,000. Okay, you can assume the loan. Now that particular house, the loan is probably a little bit less, but you have to make up the difference. So say, for instance, if he still owes $300,000 on that loan, you still have to come in with $200,000. So if you want to go ahead and put that amount down, if you were going to put a hefty amount down anyway, absolutely, that makes sense. But if you weren't, then there'd be no point to that, because if you don't have the funds, you don't have the funds, guys. That's just the truth. Why would this make sense then? Why is it so advertised on TikTok and all the social media platforms and everything like that, right? Because it's not as easy peasy. Here's the thing. It makes a lot of sense when we're actually in a buyer's market, when the home prices have gone down, when the choice of the seller is like, hey, either I sell this house at a loss, either I sell this house for what my loan is right now and not have to deal with a short sale, not have to deal with a foreclosure. I am stuck in a rock and a hard place. So I'm gonna choose the lesser of two evils. That works at that time. For this time around, it's gonna be really, really rare that that's gonna happen. In the 13 years that I've been in this industry, I've only had one time where somebody actually had buyer's remorse and sold their home within the month that they bought it. In that situation, sure, that could work. But again, within a month time frame, the interest rate didn't rise that much for you to have to do that anyway.
The other thing that Lisa didn't mention too, but Eva mentioned it earlier, it's like bait and switch deals. A lot of lenders that advertise assumable loans, it's a bait and switch deal. It's a marketing piece that they put together, and they want to be able to pull the consumer into their office and ask about this assumable loan. And when they actually crunch the numbers, it doesn't work out. And then they go into, well, since you're already here, we got other products. We got FHA, conventional, VA. What do you want to use to buy a home? You're already qualified. So that's kind of like bait and switch. When you hear it, especially right now in the seller's market in Sacramento, it's probably not gonna work in your favor. It's gonna work more in when you're in a buyer's market. That's where inventory is like 6 months worth of inventory. Right now we have 2 months, okay? And homes are gone in like 20 plus days. So it is not in this market. I have a buddy, he's an investor, and this is what he said: assumable loan is only good for investors. Why did he say that? Because investors will actually go out there and find the deal, find the owner that's super motivated to just get rid of their property because it's just hanging over their head and they can't pay for it no more. Then the investor that's able to take on that debt will just assume their loan. For investor that's willing to be that savvy and go directly to like an owner and find that kind of deal, they can find a lot of these assumable loans. But to a first-time home buyer that is looking in the market and wants something that's move-in ready and it's gonna use like low down payment or first-time home buyer programs, it's gonna be really challenging to find an assumable loan that's gonna work, because not all loans are gonna be assumable.
Right
Only
now, it's
FHA, VA, right? So if it's a conventional loan, you can assume it. If
correct,
it's
and that's
VA,
that has to be very savvy as well, because I mean, if you're flipping it and everything like that, and you're doing it one too many times, it's going to be pretty darn obvious. FHA is meant for you to live in there for a while.
For VA, you have to be a vet to even qualify to assume that loan.
Yes and no, Chia. So you don't actually have to be a vet.
On all VA loans?
Yeah.
Assumables?
You don't have to be a vet, but here's the thing. You're going to have to convince the seller, if he's not buying and using his VA for the next home, he's basically giving his VA rights to you to assume the loan. Yes.
Why would a seller do that?
Exactly. It doesn't benefit them. So yes, sure, it exists. Now, here's another way to think about this, guys. Like, say, for instance, if there's an elderly couple can't maintain the house anymore, they are on a fixed income, so they really want to live in the home and everything like that, but they can't, afford that anymore, but their kids can. So yeah, you can totally sell it to your kids in order to get this. And if that situation, if you guys have family members that you guys want to transfer this on, Chia and I've done that before for people as well to make it make sense. How do we crunch the numbers? How do we make sure that, hey, what if we can't sell it for 100 and 200,000 of a difference, but what if, because it's family, will $50,000 make a good enough dent for mom and dad to have a little bit of a nest egg, and they get to stay in the house too, and their kids are making the mortgage? Is that a fair enough way to assume that?
Yeah, and remember also, if that's not your situation, right, and you're going out into the market as a first-time home buyer, we had a client, right, Lisa, that had an opportunity to assume somebody else's loan, right? It was a house that they loved. It was in the location that they preferred. But when it came up to it, like, this seller, they owed about $200K on it, but the home was listed for, like, I think $550. So that means our client needed to bring in $300,000 of cash to the table in order to assume this loan and buy this home from this seller, and they didn't have $300K sitting around. So it didn't work out for them in that part. They got excited about it because it was offered as an assumable opportunity, but it did not work out because no bank out there, especially if you're planning on using your first-time home buyer benefit status, no bank out there, correct me if I'm wrong, Lisa, no bank out there is gonna be second in title in the liens. They want to be first.
Yes, for that situation, sure. But if there's enough equity in it, later on down the line, there's a possibility that you can get a HELOC to cover that. So say, for instance, you did pay that astronomical amount of $300,000. Okay, wait 6 months. Go ahead and get the HELOC, because most banks that do HELOCs will require for it to be seasoned for at least 6 months before you're able to get that second loan. You still have to have enough equity to pull out. And just so that you probably won't be able to get out that full $300,000. You have to keep 20% of equity in your home, whatever that difference is. It probably might be $100,000.
So that HELOC. So that HELOC, that let's say they did do it. They paid $300K upfront to get the home. 6 months later, they need that capital back, so they did a HELOC. So that means 80% of the loan, 80% of the property value now is in a loan. So that means they have two separate loan payments on a home that's worth $550K.
Correct. But here's the thing, okay, Chia? So I'm just doing the math for you guys right now. So it's $500,000. You have to leave 20%. So you have to leave $100,000. Now it's $400,000 that you have to work with. So the original loan is already $200,000. So you can possibly get another $200,000 out. Why would that be beneficial? So here's the case. If you're making more money, if you have other products out there and you have more investment vehicles that are earning you more, maybe this might be worth it, guys, because if you have this home, there's other tax write-offs that you can put in there as well. So definitely talk to your CPA about that. So you have a $200,000 loan, the one that you assumed for 2.5%. Then you have a second one that you're paying 8% right now. And usually HELOCs are about 1.5% to 2% higher than market value. So if market value right now is 8%, then it's 10% there. So you have 10% that you're paying on 200,000 on, okay? Instead of the full 400,000 that you would normally get if you weren't assuming this loan. For the second part, that $200,000 that you're getting on that HELOC, that you're paying 10%, unless your investment vehicle is paying you more than that, which I would say it needs to pay you at least 15% for that to even be somewhat worthwhile. So Lena asked another really great question. Lena asks, what are your thoughts about taking an equity out to put on another property for a rental? This is good. You have to take a look at the numbers, okay? So for investment properties, right now I just quoted somebody for putting 25% down on a home and the interest rate is 8.375. If the home equity line of credit is 10%, it makes no sense for you to take the equity loan out to cushion for the down payment for this one. unless you really absolutely have no funds for it and you have to take a HELOC out. When you take a HELOC out, that also increases your debt to income ratio. So you got to see, okay, how much do I take out here to cushion for this house in order to purchase the second house? Most of the time during this season, it's more beneficial if you can finance as much as you can on that investment home. Do that instead of taking out the HELOC because it's more expensive.
If you guys have more questions about that assumable loan topic, just shoot them in the comments. We'll answer them accordingly. But okay, we are gonna let you guys go. We're gonna close it out. Thanks for joining us tonight. All your questions were awesome. We love it when you guys engage with us. It makes us feel you guys are super interested in the topics that we're talking about. But hey, if you guys have topics you guys want to talk about, shoot them in the comment section down below. Let us know. I read all my comments. I would love to engage with you guys down there. But all right, you guys take care. Have a good night. See you guys next time. Peace.